Hello, I'm Bernard Hickey from Interest.co.nz and welcome to a special economic weather report brought to you in association with the BNZ. Today we look at commodity prices. It's boom time for farmers at the moment. The ANZ commodity indices have been going back for many a year, and this month, or at least in May, commodity prices hit record highs against both the US dollar and in New Zealand dollar terms. That's quite unusual. Often when they're up in New Zealand dollar terms, they're down in US dollar terms and vice versa, but this time we've got the double whammy. And we're seeing it across the board in dairy prices, meat and wool, even logs, fish, all up in May to record highs. And this is really driving a strong growth in the export sector. However, it does mean something for the rest of us in terms of demand pushing through the economy and putting some pressure on inflation and prices. Although how much pressure is another thing. The Reserve Bank will be looking closely at this big jump in commodity prices. It's due to make a decision on the official cash rate next Thursday on June the 10th and again on July the 29th. And most people are saying it will increase the official cash rate from 2.5% now, a record low, to 2.75% at least. So what does this all mean for interest rates and house prices? Those are the main measures we look at here at Interest.co.nz. For interest rates, this will mean more pressure on the Reserve Bank to push up the official cash rate. But we're unlikely to see the official cash rate rise as far or as fast as it has in the past. The Reserve Bank itself has said that this time around, banks aren't so keen to lend. That's partly because they've suffered some losses in the last couple of years, but also they're feeling the pressure from regulators, both internationally and here, to fund more of their lending from mums and dads in more secure forms, from local term deposits, rather than from the hot money markets. Now that means they have less easy, cheap funds to lend out, and they're going to be less likely to pump up the economy with easy credit, as they did from 2002 to 2007. That means that even though we've got a commodity price boom going on right now, it's not going to flow through to the economy in the same way perhaps it did in the past, when farmers in particular would use these high prices to jump in there and buy out their neighbours using cheap funding from the bank. Now the banks aren't so keen. They're looking to pull back some of their exposures to the rural sector in general, or at least slow the growth of those exposures. And farmers too are looking to repay debt. And I suspect a lot of this boom windfall in prices that will come from higher commodity prices will go back to the banks in the form of repayment of debt, rather than being pushed into the provincial economies. So there we have it, a boom in commodity prices, but it may not feel like it down at the provincial economy level, and it may not push interest rates up to the sorts of record highs we've seen in the past. However, interest rates are rising, and this will put pressure down on house prices. I'm Bernard Hickey. That was a special economic weather report brought to you in association with the BNZ.